Hey Goku, what's up buddy? Real quick, I'm lifting and it's bulking season, winter's here, and I have a lot of time. So you know what I'm gonna do? I'm going to first work really hard. Second, I'm gonna wear shirts every day and they're gonna have letters. I wear words about how I wanna live. Check this out. Look, I have success trader. That means I wanna be a successful trader. But when I work out, I think about you. Not in that way. Hey guys, welcome back to the After Hours. I'm the A-Tail Beast, and today we're going to talk about small caps in the market. Now, one of the things you have to know about penny stocks is that they're categorized into small caps. Now, when we talk about market capitalization, market cap for short, we're talking about 300 million and below. At least initially, there is some type of volatility. Maybe you can go up 500 million, even sometimes up to $1 billion. If the supply is diluted. And that's usually the typical story, what happens in penny stocks. The stock is usually very diluted. Now, when we trade in the penny stock market, it's the same thing when we trade shares. Each share is technically a piece of paper. We all know penny stocks are companies. A company could be boiled down to just a stack of papers, but the worth of that stack of papers has to be evaluated. And it usually is evaluated by a third party. That third party is usually backed by the government. So everyone has to do their job. Now we could take paper and we can rip it up. We can lose it, we can abuse it, we can copy it many times. Now, to take out possibility of user error, a lot of things are not done with paper anymore. It's all digital. You have to keep files, not in an actual file cabinet anymore. Instead, there's a digital folder. Everything's uploaded, it's in an email. Now, why is this important? It's because depending on which category you're looking at inside of the market, whether it's Forex, dealing with currencies, or whether it's at the bottom of the barrel with pink sheets and OTCs, where you physically have to sign off on each individual share, you're gonna have to keep track of the worth of those companies. Each of those companies can be boiled down to pieces of paper. Now, when we look at that piece of paper, the value of that piece of paper and what it represents is important. And that's usually your share of the company, but only hypothetically. When you trade a stock, you technically own the company, but technically you don't own the company. You just own pieces of the company. So a company needs funding. And to get that funding, they go to the public market. And so they IPO, which is the initial public offering. When they introduce a percentage of their company onto the public market, they value how much is that percentage of their company worth. And that's called the market cap. Depending on how much they put inside of the stock market, that's gonna trade at its value, which mostly depends on the supply and demand. If they put a large supply, demand might be small. If there's a specific catalyst or promotion, maybe the demand might spike and then the price will rise temporarily. The people that have shares, they just have a piece of the company. And if the piece of the company was put on the public, they have a piece of the company. And if there was some type of error where maybe shares were doubled or tripled, people are shorting, like AKA naked short selling, where you short shares that don't even exist. Now, we've seen several errors where there's naked short selling, where the short sellers end up with too large of a position and end up getting squeezed once things get corrected. And then that ends up causing a parabolic. And it just happens to be around the same time that there's a promotion for the stock. So there's even more incentive for the stock price to increase. But at the end of the day, it was just an error. So when we look at a typical day in the penny stocks, we can understand that errors and missing papers and other things happen all the time. Now that's just a typical day inside of the penny stocks. It also could look like dilution. Now when we talk about dilution, there's all kinds of forms of dilution. But to help you understand, let's talk about what happened this week.
This week, we saw a lot of activity inside of biotechs. Now, it wasn't just biotechs, there were also redemption SPACs. At this point, we see an uptick in the market activity, and this is a sign that the market is coming back. This is after a long period of nothing really happening in terms of A+ setups. At this point, there's still not a lot of A+ setups, but volume has come into the market. And you've seen this on tickers like INM. INM had a pre-market volume of over 30 million. When we see a massive pre-market volume like that, that's a good sign that there is going to be volume coming into the market soon. Winter in general is full of a lot of volume because people like to spend. It's also full of a lot of volatility because a lot of the time it's healthcare sectors. And in general, all stocks are just there to require funding. And that goes double for healthcare stocks. Now, when we look at INM, we can also match that with ABVC this week. Now with ABVC, this one had a third party evaluate its company's products, especially its latest products around depression and fatigue. that deal with mental illnesses. The valuation of the company currently was 3 million, but after the third party evaluated, it was 6 million. At that point, the stock went from 80 cents all the way up to $4. Now, as a general rule of thumb, we never see stocks go straight up or straight down. But in the times that they do, it's usually a promotion. After that promotion, to take the money from the spike, there was a form of dilution, and they used a warrant. Now that warrant, that was just something that was used to sweeten the deal with one of their sponsors. To get a different angle of what that means, we can also look at INM. Now INM, this is a little different. It did do a spike all the way from 50 cents up to $2, but this one didn't have a warrant. Instead, it did an offering, specifically a shelf offering. Now, when we look at the data on INM, it had a shelf of about 50 million. And just in this particular situation, they used 5 million in the last offering to take the profits from the recent spike. Now, in both these cases, they follow the same structure. There's a spike in demand, and then they dilute the supply. Another thing you might have missed this week is the SPACs. More specifically, the SPAC redemptions. Just like how having an offering as well as a warrant is a form of dilution, you can also have redemption SPACs. Now, redemption just means to reclaim. In simpler terms, once you go into a position, at some point you're going to have to close that position. Well, redemption SPACs, which are also known as shell companies, which is mainly used to complete a merger between two parent companies or used as a medium to complete the transaction between a person buying and selling. If you look in the details somewhere in the contract, you'll see a clause that says something about what if you cancel the contract? What if someone wants to redeem the contract? And then that's where redemption comes in. If someone says they want their money back or they want their shares back, depending on how large that sponsor was for your investment, that will have a large impact on your supply. Large impacts on the supply, they usually refresh the demand as well as refresh any historic activity. So if you try to use that as a resistance or a support, it makes it very hard for any sort of risk management. Now, two examples of this redemption SPACs, one of them this week is FRBN. Another one is ASPA. Now with these stocks, you may see them start out with like 6 million, 3 million, something like that. But after the redemption, depending on how many people reclaim their shares from the public market, you could be left with a very small number. In this case, it was under 100K for each ticker. And it was just earlier this year that we received the notice from the SEC that said stocks under 500K, especially under 250K, at any point they could be hit with a T12 halt because of suspicious activity. Now, if we think about it, penny stocks in general, they're very risky, but stocks that are likely to get T12 halt are easier to manipulate, like those nano caps under $1 million, especially under $500,000. These kind of stocks can be considered untradeable. And if you're in a short position, it's even worse. Not only could you lose all your money, but you also could end up owing money because you have to pay the fees day to day, and nobody will be at fault except you. The only correct way to trade these stocks is to use lottery sizes. We're talking about things that you are comfortable losing 100% in less than 5 seconds, sometimes even a blink of an eye.
So the name of the game is always taking the money from the majority. Is all the money in the hands of the longs or the shorts? And the high institutions, they're the ones that control the direction. As an individual trader, your job is to get the scraps. Once you figure out the direction, you'll see volatility, you'll see momentum, and you could choose if you want to be that momentum trader that gets the crumbs in the direction of the trend. Or if you're a guy that wants to scalp the volatility inside of the consolidation. Sometimes that consolidation might be big or it might be tight, but that in itself can be a price action signal that can alert you to the actual move. And you can take that a step further and look at the offerings, the warrants, the fundamental reasons to give you the hint of where is the majority of the money gonna be. And you can make that final decision. Do you wanna follow the crowd or do you wanna be your unique self? All right, guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.